White that's right.
She's like, what? Your kids are older.
No, they love that kind of stuff. The two little ones are 12 and 11. They love that kind of stuff.
All right, so chapter 8 is about receivables. So what we're going to talk about today is just about what receivables are, and what we're now kind of take a look at classifications. You may have already looked at a little bit of it. We have allowances for doubtful accounts, those type of things, because there are some times when we're going to have receivables, but we're not going to get paid on them because the company goes bankrupt, and those type of things. So we anticipate some of those things, and so we look at the past to kind of help with those doubtful accounts. So some of the things we'll do talk about here is describe the common class of receivables, and then the accounting of uncollectible receivables. We're going to describe the write-off method of accounting for uncollectible accounts, so how we're writing that off. And there's also an allowance method for accounting for uncollectible accounts. So you have the write-off method, and you have the allowance method. So write-off is when it happens. Allowance method is we kind of estimate. So we'll talk about those, what those mean, the differences there, and then comparing the two of those together. So that's what we'll kind of be taking a look at in this chapter here. This chapter isn't too long; it's about 60 slides, but we'll kind of go over just the basic stuff on that. And we're going to describe the accounting for notes receivable and describe the reporting for receivables on the balance sheet, and the number of days of turnover and that type of stuff. We'll see here. All right. So taking a look at this, accounts receivable are normally expected to be collected within a relatively short time period, which is usually 30 to 60 days. And most of the time it's 30. If most companies, manufacturing companies, they expect about 30 days. If you start sliding outside of that, it can sometimes be a problem too for your cash flows. And we'll talk about what that means when we get the statement of cash flows, what can happen with that. I'll kind of give you some descriptions of what some of the things that I had to do when I came into a company and changed some of those. I think I may have mentioned before. We'll talk about it again a little more in detail. All right, notes receivable are amounts that customers owe for which a formal written instrument of credit has been issued. So somebody owes you money, you may have given them an exchange, they made a commitment to pay you back. And so you may announce a loan to somebody or something like that. Then other receivables expected to be collected within 1 year are classified as current assets, remember that. And the non-current is outside of that. Examples of these receivables are interest receivable, tax receivable, receivables from officers or employees. We'll talk briefly about these, but we won't go into a lot of detail because these are, a lot of times you won't see them a lot out there, but you'll see some of this sometimes. Questions so far? All right. So companies often sell their receivables to other companies. This is called factoring. They basically do that to get their money sooner. And so sometimes when you go to a car dealership and you get a loan through them, sometimes they sell it off, don't they? Or a house. I think my house has been sold off once or twice. You know, and so that's what they're selling off those loans or those receivables expected things that they're getting. Also, companies do it too. You have just a basic receivable because they need cash right now. So sometimes they do that. So sometimes that's what we're talking about here is basically selling off that. And you're obviously not getting 100% on those receivables. You may be getting 80, 70, depending on how much they are, how big they are. And should be there. But that's what they do to kind of generate some money sometimes, is to sell those receivables. And then that way they're not responsible for collecting on those. It puts the burden on somebody else, but they get a smaller amount of it. So regardless of how careful a company is, granting credit, some credit sales will be uncollectible. Remember that, we talked about that. And so the operating expense reported as uncollectible is bad debt expense, uncollectible accounts expense, or doubtful accounts expense, depending on how we classify it and how we're doing it. Remember at the beginning of this chapter, I showed you a couple different ways. And so that's what we'll talk about, why those classifications are a little different. All right, so some indications that an account may be uncollectible include, well, they are past due. They haven't paid. They're late, and that's, as we all know, just from our own personal, that we can see that sometimes that can be the case. The customers does not respond to the company's attempts to collect, obviously. They're not responding to our phone calls, just like if you've ever worked for a collection agency and you've on the call phone trying to call somebody, they don't pick up. There you go. It happens
Worst
there.
job ever.
Yeah. And so when I'm saying personally, that's what you might remember is being on that side trying to collect. The customer files bankruptcy, then you're out of luck. You may get a small portion of it depending on the bank, on that company, how much they have in assets. But let me just tell you, it's really, really low on that total pool there. And we'll talk about that if you're continuing on accounting to other accounting classes, on how you deal and who's in the priority on those bankruptcies. The customer closes its business, obviously, so that's part of it too. And the company can locate the customer. They disappear.
White shadow.
Yeah, white shadow. There you go. All right. So the direct write-off method of accounting for uncollectible accounts records bad debt expense only when it is determined to be worthless. So remember that. So this here is a direct write-off method. Direct meaning we do it when we figure out we're not going to get collected on that. And so the allowance method is a little different. We estimate the uncollectible for a year or whatever that period is. And we go, okay, this portion is not going to be collected. And so we anticipate that and already put that in there as a buffer. So that's the difference. So direct write-off, when it happens, allowance, we do it, we
So how
put
do
something
you
aside.
figure in advance that something like that's going to happen?
So a lot of times you do it historically, how much, so maybe percentage, maybe 1 or 2% of our accounts receivable is not going to be able to be collected. And that's what we've seen in the past, and so that's where we estimate some of those things. So we usually use the past as a kind of a guide. It's not always perfect, so sometimes you're off a little bit, low or high. And so that's part of it. And we'll take a look at those problems and how that all works. So, but it is kind of an estimation. You're just kind of guessing a little bit on it, but an educated guess. All right. So now we're going to take a look here at the direct write-off method. So this is an example of a problem here. So this is the bad debt expense, accounts receivable, and basically this company, we figured they're not going to be able to pay us. DL Ross is not going to be able to pay us the $4,200 they owe us. So we have determined that to be uncollectible. Now what happens here, the account is written off on May 10th and is later collected on November 21st. So now we've actually collected it. So now we have to go back and change some things again. So if you remember here on this one here, we debit bad debt expense, because it's expense, remember we're going to debit that, and then we credit accounts receivable. The reason we credit accounts receivable is they no longer owe us that money anymore, at least in there. Because we're pulling it out of that because we're not going to be able to collect it. That's what we're anticipating, and that's what we had moved it into here. Now, I said, remember, they don't owe the money anymore, but we know they do. So what happens is they decide to pay us. Well, now I've got to credit that back into accounts receivable and then bad debt expense. And then pull that again out of accounts receivable after they pay the cash. So now they don't owe it again. So that's why I have the two transactions. Basically, reversing that first one we just saw, taking it out of bad debt expense, and then paying it off. So that's what's happening there. So that's the direct write-off method. So that's the reinstatement entry, and basically it removes the previous entry, and then there's a receipt of cash entry there. All right. This is brand new. All right, the allowance method. So the allowance method, we take a look at, we estimate that a total of 30,000 of the 200,000 balance for accounts receivable bunch will be uncollectible. That is a large amount. And really, as a company, I'd be really concerned. I'm not looking at who I'm giving credit to. That's a high percentage of, now the 30,000 and 10 million, well, that's not that much in comparison, but we're talking about just 200,000, that is. And so what we're going to do here is then, we debit bad debt expense, and then we credit allowance for doubtful accounts. And what that allowance for doubtful accounts is going to be in our assets. And we're going to pull away, kind of like our depreciation did. So it's a contra asset. It pulls away from my accounts receivable. I now have less value of my accounts receivable because I have allocated 30,000 of it to not be able to be collected. Does that make sense? So we're basically pulling away just like what we did with depreciation. So it's a contra asset account. So the net amount that is expected to be collected is 170. That's just taking the 200,000 minus the 30,000. and it's the net receivable value, the receivables. And the adjusting entry reduces receivables to the NRV, which is the net realizable value, and matches uncollectible expenses with revenues. So we'll take a look at what all that means, the verbiage, because it's more confusing than actually taking a look at it. So in here, what we're doing is now this John Parker account is written off because it's uncollectible. Basically what we do is then we debit allowance for doubtful accounts because we're taking away from it, so we've used a portion of that. So we had 30,000 of it. If I now debit that, and that's a credit balance, now I have 24,000 of it, right? And so what we're doing then is taking away from accounts receivable John Parker because now he doesn't owe us that anymore because now we've just written it off and it's done with. Obviously, we know he still has that commitment to us, but we're taking it off our accounting books because we just don't think we're going to collect. Now, notice that too, it's not the bad debt expense because we already put the bad debt expense when we did the allowance prior. So that's why it's not. So the allowance method here, this is kind of the different buckets it goes into. As you can see, the adjusting entry, the allowance for doubtful accounts, and that you're paying off, writing off the accounts over time. So you have the direct write-off method and the allowance. And the allowance takes into account what you expect not to have. Or the direct write-off can sometimes surprise you a little bit. Especially if you're a leader and you're not paying attention to that, you may not get paid. All right, so the allowance method here, they write off $26,750 of uncollectible accounts, including that $6,000, so they included that. The account for John Parker, after posting all entries to write off the uncollectible accounts, the allowance for doubtful accounts will have a credit balance of this. That will be what's left over. So over time, we find out, well, we estimated a little high, which is a good thing, because that means they paid us, we didn't have as much as we anticipated. So we have that as a credit balance there. Questions? Because of that, so the company is, now this one here, the company's written off 32,100 accounts receivable during 2014. The allowance for doubtful accounts would have a debit balance of 2,100. So that means we have a debit balance of it. So we'll need to fix some of those things there. All right, and we'll take a look at some of those in the upcoming slides. So Nancy Smith's account, 5,000, which was written off on April 2nd, is later collected on June 10th. So 2 entries are needed, one reinstated. Remember, so we basically get rid of the first one, and that's what that happens here. And then the cash receipt of that. So they'll show us that again. All right. I'm going to have you guys do a problem real quick here. So if you turn your books to page 384, PE 8-1A, I'm going to have you do a direct write-off method with one, and then we're going to do an allowance method one in just a second too. Right after that.
Sorry, PE what?
8-1A.
Oh, yeah.
we kind of walk through with you guys. So on February 12th there, we received cash, $800, is that right? And then we have, we're writing off some of it because it's not going to pay the rest of it. So we have bad debt expense of $2,400, it looks like here. So that was $2,400, which the total of that, the accounts receivable for, what was it, the gentleman's name? What was it? Obviously, I'll put accounts receivable. We'll just leave it as that right there. So the accounts receivable.
Isn't it 32?
Wow. Yeah, my math goes good. Well, I guess you want 3,000. Thank you. 24 plus 8 equals 32.
No, it's like, did I add it wrong?
All right. So questions on that one? Pretty good? Other than how I got 24 plus 8 is 30?
It's late.
Yeah, it's late.
It's getting there.
All right, so what was the date on this one? March?
Third.
May 3rd. Yeah. All right. So now we have to reverse some of this because we're getting that in, right? So we have to reverse the accounts receivable here. So accounts receivable for L, I'm just going to call and then we have 2,400. Sorry, this is pushed down a little bit. And then bad debt expense, we're going to turn this around. Now the reason why we're not doing the whole accounts receivable, because that 800 went towards that. So that's why this will be 2,400. All right. Questions on that part? Then what do we do? All right, so we get pays as cash, and then now we write it again as accounts receivable, and that is for the 2,400. 24,000. It's 14 days. All right. So questions on that? Make sense? No problems there. So basically, taking that first transaction in, then that debt, then we had to reverse it right here, and then taking the cash in for that. All right. Let's do the next one, which is 8-2A, which is the allowance method. Kind of what we just looked at here. So I'll leave this up for a moment before you get down, and we'll do the 2A. On the next page. Not much difference, right? Just change it from bad debt expense to allowance for doubtful accounts. Because we already put it to bad debt expense before that. So that's all I did was just change those two from bad debt expense to non-deductible accounts. So questions? So that's 2A. So that's similar to a couple of the problems that you'll have in your homework. We'll see some easy ones like that, and we'll work at some a little more difficult ones. All right, let's continue moving on here. All right, so the allowance method requires an estimate of the uncollectible accounts at the end of the period. Two methods are used to estimate the amount. So we'll talk a little bit about how we do that. So the first is a percent of sales method. So your usual percentage, and usually, like I said, you look back at the history, historically what we have, and then analysis of receivables method. So we'll take a look at that and what we mean by that here. And when the analysis, when we really look into it, is well, how many people are outside that? Who are the ones that are in trouble, we think? And kind of analyzing and taking a look at that, and then start taking some of those values as a part of it. So there's two different methods there. So the percent of sales method basically is this. The company's credit sales for the period is $3 million, and it's estimated that 0.75% will be uncollectible. So 22,500. That's more in line than what we saw before, which was huge in comparison. So that's how we do it. So we disregard the balance of the 3,250 in the allowance account before the adjustments. So we're not going to worry about that for the adjustment there. And so this is what we would do. Basically taking that money there, and now we'll have an additional balance. So we have this at the beginning, we'll add the more in, and that gives us a new value, which is right here, this value here. We'll take this value here into it. And they usually will show you how they came up with that, because otherwise you don't know. You're guessing too. So that's sometimes why you show that down there. So questions? How they came up with that? So 22,500, just 3/4% of that, 3 million. All right, so that's the percent of sales. Now let's look at, we'll finish this off real quick. These are adjusting entries that you would make. So we now add to that the allowance for doubtful accounts. So now we had a $30,000 balance at the beginning of the year. We now have a $25,750 balance. We noticed we didn't use as much as we anticipated, and after looking at our percentage of sales, this is what we should have. Now, analysis of the receivable method, which I was just talking about there, is we're looking at our aging of the receivables. So what's outstanding out there, how long they've been out there, and what are basically analysis of that. And so kind of diving in and seeing what our customers, their likelihood of paying us, take it that way. So the analysis of receivable method is applied as follows. So step one, the due date of each account receivable is determined, when it's due. And then the number of days each account is past due is determined also, how far they're out. And then each account is placed in the age class according to its days past due. Those type of things there. And we also could see sometimes where these companies have been to. I would take it a little further than that, but the totals for each age class are then determined as a part of that. So how far they're out. And you'll see that with a lot of companies go 30, 60, 90 days, 120, we don't be able to get to, but 30, 60, 90, and you'll see a lot of that, how far are they out. And so that's what they'll take a look at. They don't want those companies that are out to 90, we need to move them back into the 30 area. So, but that's what we may estimate, some of those in the 90 may fall off, and we may not be paying for some of those. Step 5, the total of each age class is multiplied by an estimated percentage of uncollectible accounts. So you take each of those, break it all down, and what percentage of those are not going to be collectible. Because even in the 30 days, they may not be collectible there, because they may slide to 90. We just may know that that company may be struggling and may not be able to pay us. So we may have a percentage there. And the estimated total of the uncollectible accounts is determined as the sum of the uncollectible accounts for each age class. So we add it all up. We'll take a look at that, what that means in just a second here. So the preceding steps are summarized in an aging schedule. This process is called the aging of receivables. So this is kind of what it looks like. I just kind of give you an example there. If you follow this category, you're in a lot of trouble here. That's a lot to be out. And anything over 365, good grief, you may not get paid. Then maybe because you're out with a lawsuit or something like that, then you put it, I'm not sure. Or a lot of times you won't have that. By that time, I've already written it off. So that's kind of a breakdown of what those are. So these are the percentages here, other ones are, as you can see, it's growing. No past due, you see how it keeps going up, the percentages. Well, the longer you're out, more likelihood they're not going to pay you that. So that's some of the things, so why that's continuing to grow. And so you take percentages of each of those, and then you add it all up. That's basically what that is there. That would probably put that closer to 100, but.
That's like huge.
Yeah, it's 365 days
We only
way out
have
there.
240,000 receivables and 26,000 of it's
Yeah, okay.
collectible, that's a lot.
Yeah, and so that's, even here at 50%, I would take that a lot higher, but myself, but that's what we're doing for this problem, so. But it depends on your type of company too. Maybe it's because they give them a lot of time to pay. Maybe that's, usually I wouldn't like to do that because my cash flow will be struggle if I do that. But you have to know what the industry does too, a lot of times, so. All right, so the estimate based on the age of receivables is then compared to the balance of the allowance account to determine the amount of adjusted entry. So then we need to figure it out. So if we have money left over in there, then we'll just add it and get it back to where we think we need it. And so that's what we'll do. So that's what we're basically saying by this statement here. So this is the balance in that account, 3,250. And so the estimate then collectible will be 26,490. Because of that, that means we only need to add 23,240 to get us to that. Because we already have some money in there, and we need to get to this number. So we just take this minus that. It gives us what we need to do to get us to that number there. And that's all this is here. And so we have the expense of bad debt, and then we have the allowance for doubtful accounts. And they got that by subtracting the two numbers there. So in here, this is what it looks like if we take a look at the bad debt expense and then the allowance for doubtful accounts. You see the totals here. That's the new bad debt that we're going to put in there in the adjusted entry. And then here is a total in there for my adjusted balance. So it's a balance that I thought I determined I would need. All right. So the unadjusted balance of the allowance account has been debited for the 2,100. The amount of the adjustment would have been 28,590. So what we need to do is, if we had, this was our balance here because we used more of it, we'd actually have to have more we put in to get us to that number. Right? Because we got more of the negative over here, if you want to picture it that way, and we need to get us something more positive. So that's what that is. It's just a different shot compared to the one before that, where we had extra money here left over. We just add a little bit more to it to get it up there. This one here, we were short already, so we need to add more. And this is kind of what it looks like there. That should be in your book. Basically showing all those things and what it means to each of those accounts. Looking at the T accounts. So you can see the different T accounts and how they work. So this is the percentage of sales. This is our analysis for the receivables method there. All right. So questions on that stuff? All right. Well, let's take a look at one right now. Let's take a look at 8-3A. This is taking a look at the percent of sales method. I'll give you guys a moment to take a look at that one. A good example of that one is on page 268. I'll kind of walk you through that problem. working on this right now. Remember, that's 0.75%. So it's 0.0075. Questions how I came up with that? So our accounts receivable then is 685,000. Give this to us. And then our allowance. Call it doubtful account DA. 64,500. Which is 5,000. 5,000.
Why 64,500?
There was an additional value in there already of 9.
So you take that out of your net realized?
Yeah. So
Okay.
my net realized value is basically my accounts receivable minus my total value of my doubtful accounts.
Okay.
Set, and that's my total value of that. Now what I'm going to have just for that year or adding to it.
Okay.
So yeah. Question. Any other questions? All right, I'm gonna have you look at 4A now, the next one. It's gonna be similar but a little different. Again, we're now looking at the analysis of receivables method here. Let's do that. All right, go ahead and start putting up the answer there for us. So that's what you should have for the first part. Minus 9,000. So that's my allowance there. So I take away what my allowance is, and then realize.
If you wanted that, it says specific right now.
This right here?
Now keep going down with your hand over towards you.
Right here?
Yeah, that should be 685.
Oh, yeah. That's all the 35, thank you. 685, yes, you're right. I'm just checking it, make sure you're checking me.
Oh, that's fine. It's keeping me awake. There's so much to do tonight.
Thanks for catching me. All right, so how are we doing so far? All right, let's continue moving forward then. All right. So here's the comparing the direct write-off versus the allowance methods here. So you can see the differences that we have, the different transactions that we've done, that can be done. And so what you don't see here is the entry at the end because you don't put anything in the allowance. That's really a lot of the difference there. And the difference between going into bad debt expense each time, this goes into the allowance method each time because we've already put it into the bad debt down here, or it's here. I'll give you guys a moment to kind of compare that and read that real quick. And that just kind of gives you a snapshot of what we've already talked about. I'll give you a moment to do that. Questions? Did I go too quick? All right, so now we're going to describe the accounting for notes receivable. So notes receivable here is a promissory note. Somebody's going to commit to pay us. So it's a written document that's promised to pay, and characterized with the maker is the party making the promise to pay, and then the payee is the party to whom the note is payable. And the face amount, obviously, is the amount for that, what is owed there. We don't have some additional things that go into that. The issuance date is the date the note is issued, pretty simple stuff there. And then you have a date of maturity, the due date or maturity date when it comes up to due. You'll see this when we get into bonds too a little bit. You'll see what's similar to this in a lot of ways. And the term of the note is on the amount of time between the issuance and the due date. So basically just think of it as a loan that you may have gotten it out or something like that. It's similar to that. And then you have an interest rate that's a part of that on that. And it could be paid semi-annually, annually, monthly, however you have it set up. And so this is kind of what it looks like here on the promissory notes. I pay this. It looks kind of like, you know, just very, very simple statement here. All the information that you need. And the promise to pay them by this. And by that date. And you see the value to receive the interest at 10%. So the maturity value is the amount that must be paid by the due date, which is the sum of the face amount and the interest. And so typically when you do those type of loans, so they're short-term loans. This one here is, yeah, it's a couple months, looks like here. So that's just a couple months and they're going to pay that. Actually, it's 3 months. Yeah. And so it's a short amount of time. So we have 90 days from March 16th, and that's what that basically comes out to, about 3 months. And so with that, you just pay the interest at the end. That's pretty nice interest. Now, unless that's not annually. So the value with interest at 10% doesn't state that that's annually. That's why it's pretty nice interest there. So March is 31 days, and then minus the issuance dates, 15 days in March we have remaining, and then add the end of April and May, and then part of June. So that's how they came up with the 90 days. Pretty simple, just look at the calendar, count that out. So 90 days in total. See right there. All right. So these are the due dates, the dates for all of that. Pretty simple stuff, so I'm just going to kind of just fly through it here. That's not the important stuff. So received a $6,000, 12%. So this is, we're going to try to take a look at a different one here. Received a $6,000, 12%, 30-day note in settlement to the account of this here. So they're settling up this. So instead of paying me with accounts receivable, they're going to pay me, give me some interest on it. And so this 12% probably is an annual 12%, so we're going to get 1% basically on that. So we divide that by 12. And so that's what's done here. 12% times 330 out of 360, which is 112. So basically 112. So we'll get 1% over that. And so that's where it comes up to 660. So I get cash in, notes receivable, and interest revenue as a part of that. Because I had additional revenue I made because I gave them that loan, gave the extra 3 days to pay it. So that's how that's broken down there, and that's the cash, that's the total cash that we got here. Questions on that? How that worked out? Now, if the company failed to pay the note on the due date, it is considered a dishonored note was receivable. The note and interest are transferred back into the customer's accounts receivable. Put that back in, and then we're able to do the other stuff that we did before. So we put it back into the accounts receivable. The reason being here, notice that interest revenue, they owe us that $60. We were earning that $60 on that, but they still owe us that. So we're putting that back in there. All right. So now accounting for notes here, we have another one here, a 90-day 12% note dated on December 1st is received from Crawford Company to settle its account, which has a balance of $4,000. So again, we move it over from accounts receivable to notes receivable. So we just subtract one asset to add to the other asset. That's what the first thing we're going to do here. Now it's 12% again, so it's going to be 1% a month. So 90 days, 3 months, 3% we're going to get out of that. So that's what basically this is here. And you'll see a lot of times we'll do the 363 and 30 out of 360 because of just making it a little easier for us. But it's basically 112 every month. So that's where they get the $40. So we have interest receivable now, and now interest revenue. And we're doing that every month because we're owing that to us. This is just for 1 month. We're doing a snapshot here of 1 month. And so at the end of all this, we have, they paid us their interest there. Because remember, they owed us $120 because of $40 every month that they owed us. So that's where we came up with 120 here. So 4,120. There's our notes receivable that we did. We have interest receivable of 40, and then they didn't do it the next month, so they just put it all into one last month here, which is interest revenue. So we must not have done another journal entry after that. So that's what's all coming in right here. So that total is 120. They all balance out. And the reason they probably didn't do it was they did because it was the end of the year last. This one here, it's December. So they want to make sure they put that in there for the adjusting entries and make sure that was counted for the previous year. So they didn't do it again until everything goes down. So that's the reason. All right, so questions on that? Pretty simple stuff so far. Not too bad. All right, so now we're going to look at the effects of the balance sheet here. Now remember what this does. Just like the depreciation does, accumulated depreciation, it takes away from that value of that asset. So now that asset is going to be less. So we may have accounts receivable and less allowance for doubtful accounts. I had $305,000 they owe us, but I'm only going to collect on $292,700. That's what I anticipate. That's my value of my account, because this $12,300, I figure I will not collect. And so that takes away from that asset. So that way I can accurately report what I actually have, what I actually I think I'm going to have there. And so that's what we want to make sure we do. All right. That was quick. And questions on how that works? So pretty simple there. Now we'll get a little more complicated stuff, but it's real quick here. And it's basically analyzing this information here. So the accounts receivable turnover measures how frequently during the year the accounts receivable are being converted into cash. So as a part of that, what you're looking at here is you have accounts receivable turnover, so net sales over average account receivable. Remember that word, average, because the average is the important thing there, because that means we have to take the beginning and ending. We'll take a look at what that means here. So on this one here, basically we're looking at, this is our net sales. Obviously, this is in millions here. I mean, this is considerably more than that. So we have 34,000, it's gone up a little bit, but we take the accounts receivable beginning and then ending here. And to get that, we just take the average. So you can see this is the average of each of these, and then we take that number into our sales, net sales. And that's how we figure out these amounts. So we turn it over just a little less in year 2 versus year 1. FedEx there. Questions on how we do that? So take the average here into that, and that'll give you your value there for the turnover. So the next part of the problem is now we're going to take those number of days sales and receivables. Is an estimate of the length of time the accounts receivables have been outstanding. So now we're going to take a look at another way of estimating some of those things. So we'll leave some of this value here. So as we take a look at this, the next part is we're going to take the average accounts receivable, the information that we have, and the average daily sales. So we get the average daily sales, what do we have? Well, we got to figure out what our sales were. We have that information, right? And then just divide it by 365. And so that's what we've got here, average daily sales by 365, and the number of days sales and receivables. So this.
It's the same as before, right?
What's that?
It's the same as what we went before, right? Did this before earlier?
Yeah. It's similar to this stuff. Yeah, we did. Yeah, similar to this stuff we did before. Yeah. So that's what you would do there. So we took that information and now we're using it for this problem. Are you guys ready to try one on your own? No? Okay. Then never mind. But I think we need to. Just to make sure we have it. 8-6A. That's a different page now, isn't it? Yeah. So a good example is up here, or you can look in your book on page 377 is a good example there for you in your book. That's what we six. we do in that first part? Questions on how we got that? Basically took the average of these two, get my average, which is here, took that number, and that number.
This part makes sense, it's the next one. To me, anyway.
Yeah, it's a little different on some of the things, because you gotta figure out the average daily sales divided by 365. It's just a little different than how it's set up, so number of daily sales. Try to get all into here. Let me see on the video. So this one, we basically took the net sales, which we already had from the previous. We take our average daily sales, which we divide that by 365. So we take that and divide by 365 the net sales, and that gives me the average daily sales. We have our average account receivable because we just have beginning and end divided by 2. Gives me the average, which is right here. So this is the answer. It goes down to here, and then took that information and took our average daily sales there. That one into this one here. So reviewing this, the last part of the problem asks us what are the thoughts about the comparison of these two between the compared years. We're turning it over less, which is not a good thing. We want to turn over accounts receivable more. Now remember this, it just depends on the size of your company, so it can be varied. That's what we're comparing against ourselves. So this is better here. Obviously our days too. It's taking longer days than the accounts receivable. Not good. This is an unfavorable trend in both parts of this. So we need to take a look at why is our accounts receivable this way? Are we handing out credit to companies that we shouldn't be? Or maybe we need to shorten that time frame. And we should look at our accounts receivable, look at our collections department, and see what we can do there. All right, so questions on chapter 8, receivables. Questions at all?